Michael, welcome. You say the best way to fight a decline in earnings growth is with growth stocks. Explain.
Yeah, as earnings growth becomes scarce, or really anything in financial markets becomes scarce, investors often gravitate towards it and pay up with a premium. And so we're just coming off of one of the strongest earnings recoveries in history over the last year. But looking forward, that's going to change pretty dramatically. So I can understand today why a lot of investors believe value is the right way to go. But I think that's a little bit backward looking rather than forward looking. And I think the list of concerns, nowhere did I see for investor concerns on what you just showed, Tyler, is a growth slowdown. And I think that's going to be the concern in 6 months, in 12 months, and in 15 months when the global economy is a lot weaker than it is today.
So you're not quarreling with the idea, far from it, that growth is going to slow and that earnings growth is going to slow and that the economy globally may indeed slow. But the best way you think to combat or blunt those effects is to invest in high quality growth stocks, names including Microsoft, United Health, AutoZone, ExxonMobil, and Procter & Gamble. You don't think of Procter & Gamble as a big growth stock, Michael?
Well, it's a combination of stable, visible, profitable growth. So we're not necessarily recommending the growthiest stocks. And I think that's a mistake investors often make. When growth works, they think of sometimes just let's find the fastest growers. And that's not always the best investment strategy. That tends to work best when growth is slowing and rates are coming down like 2019. That's not what we're looking ahead towards this year. It's more going to be earnings growth slowing in the midst of a Fed tightening cycle. So it's a good growth backdrop, but it's not as good as it can be. So you really want to stay with a lot of the quality current growers, those companies that are already profitable, not those that are going to be profitable someday in the future.
Is there anything specific entering your sell zone right now, Michael?
Well, yeah, I'd say anything deep value. And I really think we're going to see a 180 over the next 6 to 9 months in terms of leadership. Right now, small cap value has been the best performing part of the market year to date, which makes sense in the backdrop of really strong growth, rising rates, and higher oil prices. As we go forward, though, I think the narrative is going to shift away from today's concerns, especially away from inflation, which I know is controversial. But inflation, let's face it, is a very much of a lagging indicator. The global economy is going to look a lot different in 9 and 12 and 15 months going forward. So I think as that plays out, investors will react, as they always do, and shift into more higher quality companies. I'd avoid deeply cyclical, high beta, low quality names.